So if you're like me, you probably did not learn personal finance from your parents. And chances are, your parents probably even said something to you along the lines of, don't invest in stocks, you're going to lose a lot of money. And I can kind of understand where your parents are coming from. 2008 was a painful time. The year 2000, the dot-com bubble, a lot of people lost a lot of money. So I understand that. However, depending on what circle you go into, depending on what groups of people you talk to, you may very well hear that there are other people that are making lots of money on stocks. Maybe there is some validity that you can actually use stocks as a way to have financial freedom and eventually retire. My name is Dennis, and this is Financial Freedom with Dennis. You don't understand stocks. And I don't mean all of you guys, but most people here probably don't understand it. And I hope that today with this video, I can kind of dispel a few myths and help change your mindset a little bit. You see, stocks are not lottery tickets. Behind every single stock, there is a company. And I understand that there's that old adage where you want to buy low, sell high, and the stock prices are moving like that. And that makes a lot of sense, of course. However, statistically speaking, day trading is not a winning strategy. There are definitely people out there that are successful day traders. I don't want to discount that. But most of us probably can't make it as a day trader. So instead, I want to focus on a long-term investing strategy that can work for most people. So I will say that the vast majority of people should probably just buy an index fund, and they will gain about 10% every single year, 8 to 10% depending on what metric you want to say, and from there you can continue to gain money. Every 7 or so years you will double your money just by doing index fund investing. However, I know that there's a select population on YouTube that does want to learn how to individually pick stocks. And for those people, I hope that you do not treat stocks like lottery tickets. You see, I'm not like most financial YouTubers. I didn't come here to sell you a get-rich-quick course. I'm not here to sell you a day trading course. I don't really believe in those things. I came here because I wanted to share with you a systematic approach for long-term investing that will work for most people. I got my humble beginnings in finance from playing video games. Specifically, if you go and look at my old videos, you may see some videos of me playing a video game called MapleStory. Back then, it was a pay-to-win game where people had to spend hundreds or thousands of dollars typically to become successful in the game. The reason why I had my fame on MapleStory is because I spent $0 in the game and still managed to become one of the wealthiest players there. By understanding business, delayed gratification, and investing, I was able to get to where I was in MapleStory, and I took those principles into real life. And I currently hold a 6-figure portfolio, and I hope that in the next 4 years or so, I can become a millionaire. If you want to come with me on this journey, go ahead and click the subscribe button, and hopefully we can learn a thing or two from each other. Alright, so where were we? Oh yeah, I remember. Stocks are not lottery tickets. Behind every stock is a business. Let me explain. When you buy into a stock, you're buying in as a partial owner of a business. And the best way for you to remove the idea that you should just look at the stock price as it keeps going up and down is to envision yourself as an owner of that business, right? You buy a stock, you become a partial owner, therefore you should look at the business as if you were the owner of the business. So imagine you're the owner of a business. How would you look at that business? You're no longer looking at the stock price going up and down every minute or so, right? And rather, you're looking at things such as the net income. You want to make sure that keeps on going up. You want to make sure your margins are going up or staying steady. You want to make sure competitors are not taking market share away from you. You're worried about other things, right? You want that revenue to go up or stay consistent. You want to do many other different things, right? And those are the hallmarks of good businesses. But don't just take it from me. Let's go ahead and take a look at what world famous investor Peter Lynch has to say. Peter Lynch said, and I quote, "There are reasons for stocks to go up. This is magic. It's a magic number, easy to remember. Coca-Cola is earning 30 times per share what they earned 32 years ago. The stock has gone up 30-fold. So in other words, the stock has gone up and multiplied its price by 30 times. Let me illustrate this point to you. Stocks can get very confusing, and you might look at all the different ratios, price to earning, price to book, price to whatever ratio, and there really are a lot of them. But let's forget about all that for just a second, and I want to illustrate the point. Okay, so let's say that you have a vending machine business, right? Let's say the vending machine itself costs $2,000, right? Okay, so you get this $2,000 vending machine, you put it somewhere, and you want to sell drinks, you want to sell sodas, right? Okay, cool. So you have to buy the drinks and sodas, of course, and then you want to sell it for higher, right? So let's say that every single month you make $100 profit from your vending machine. After all the costs are settled, you have $100 in your pocket every single month. And you keep on doing that. Every month you get $100. It's very consistent, right? Just for the sake of this example. And how many months will it take you to break even? Well, it costs $2,000 for the vending machine and you get $100 a month, so it will take 20 months for you to break even. And then after that, everything else is profit in your pocket, right? And when you look at it in that sense, you can actually apply those same ratios, price to sales, price to book, price to whatever ratios, you can still apply those. You probably won't follow the same accrual basis of accounting. You might just go cash in, cash out. I mean, that's a different argument for a different day. But the point that I'm making is, if you have your own business, you can still use those same metrics that you would apply to a business such as Apple, for instance, right? So whether you have a lemonade stand which has a market cap of $10, or whether you have Apple which has a market cap of 3 trillion or 2 trillion, whatever dollars it's at right now, it's still the same thing. Stop looking at stocks as just prices moving up and down. Every single stock has an underlying business behind it. This video is sponsored by me. Have you ever watched Gordon Ramsay in Kitchen Nightmares? You know, that one show where he goes to a failing restaurant that's almost bankrupt and he screams at everybody and he eventually turns the restaurant around, or he tries to? Well, I'm Gordon Ramsay and you're the failing restaurants. I'm starting a new series called Financial Doctor, where I look at your personal finances, whether you're in car debt, whether you have credit card debt, other loans, or you're in a bad financial situation. Go ahead and email me at dennisfinancialdoctor@gmail.com. Go ahead and explain to me your personal financial situation. Send me copies of your credit card receipts, your bank statements, all those things, so I can understand, help you budget, help you understand where you're going wrong, where you're going right. Because I'm Gordon Ramsay, I'm going to be a little bit rude, but I hope that this video series can be some ongoing series where I can be entertaining and at the same time helpful for not just the person who needs help, but also the people who are watching. And with that, let's get back to the topic at hand. So by understanding the similarity between a lemonade stand or a vending machine business and something such as Apple or Tesla, which actually has real cash flows, these are considered productive assets. And I want to contrast that with other assets that you may be aware of: gold and silver, cryptocurrencies, and even something more recently such as fine art. If you've heard about Masterworks, people are talking about fine art as an investing vehicle. So let's go ahead and talk about that, right? In contrast to something such as a vending machine business or something such as investing in Apple, these are considered productive assets. On the other hand, cryptocurrencies, gold, they are non-productive assets. And Warren Buffett has famously said, if you buy a whole bunch of gold and you put it to the side, you know, you can look at the gold, you can fondle the gold, you can, oh, it's gold, it's great, right? But then 15 years down the road, you look at that same piece of gold and it's not changed. That's what I mean by an unproductive asset. On the other hand, if you have a business that's actually producing real and true cash flows, every single year you should see some growth. You should see some improvement. And the main point that I want to bring is that as a business owner, when you buy stock, you become a partial business owner. When you're a partial business owner and that business makes profit, you as a partial business owner, you as a shareholder are entitled to some of that profit. That is why businesses are not lottery tickets. And that is also the reason why I don't like to invest in non-productive assets such as gold, cryptocurrencies, fine art, because those are assets that even if you let them sit for 15 years, they're not producing anything. I'm not going to go as far as to say that these assets are considered lottery tickets, but what I will say is, for me, these are assets that are very unpredictable. I cannot predict the cash flows like I can with the stock. With the stock, just like Peter Lynch said, right? Coca-Cola's earnings, old school Coca-Cola, not right now. Coca-Cola back in the day, their earnings went up by 30 times. The stock price went up by 30 times. That's something that's more predictable. On the other hand, something such as cryptocurrency that's jumping up and down every other day, I mean, I have no clue. Maybe cryptocurrencies really will save the world and they'll be really expensive. Or maybe cryptocurrencies will crash and everyone will forget about them in 15 years. I really don't know what the difference is. So that's really it, you know. I feel like this is advice that's applicable 20 years ago, it's applicable right now, and it will continue to be applicable into the future. As long as you treat stocks like actual investments and you treat them like they're actually businesses, and when you buy those stocks you become a partial owner of the business, which means that you're entitled to those profits that the business produces, you will probably do better than most people. Alright, that is it guys. I hope to see you guys in the next video, and if you yourself or maybe you know somebody else who's in a tough financial situation, they're dealing with a lot of debt, a lot of credit card debt, a lot of whatever debt, and they want to be part of this show where I roast them like Gordon Ramsay would, and of course I will hopefully provide some solutions after the roasting, then go ahead and email me at dennisfinancialdoctor@gmail.com. There's more information in the description below. But aside from that, I'll see you in the next video.